Thank you, Mark. So just let me bring forward my point here. I don't think I'll be able to give you an entire story of how to manage cash flow. So my session today would very much be hoping that you guys can have a little bit of action points that you can take from what I'm talking about, and just really bring your company forward with some of the tips that I've gone through. So myself, I've done my entrepreneurial stint, ran a company for 12 years as a CEO, CTO, and thankfully exited. So I'm currently a full-time student doing my PhD. That's for another day. But today I'm going to share with you some of the action items or little things that you can do on cash flow itself. So the very first question, obviously, getting cash is always a good thing. And who doesn't want to get cash? But is fundraising the only way to get cash? I think that's the knee-jerk reaction that many startups and many founders these days always think about. Well, I mean, Ben has covered it very well, right? You have your sales channels, you have sales, you have customers, your distributors who are in fact your customers. You could fundraise with your investors, or you could even get third-party debt, invoice financing, invoice factoring, credit lines to get cash. That's the traditional way, or at least how I see it. And as an entrepreneur, let's face it, we can do much more than this. So what are some of the little things you can do? The very first thing, adjust payment terms. These are exactly the same adjustment levers that Ben has exactly said, right? Earn faster, earn more, spend less. Change the payment terms between your supplier, yourself, and your creditor. I mean, that's one thing. But what else can you do? Let's sell. Let's sell whatever you can sell. You may have a product in your company and you want to sell that product, but people out there may not want to buy your product as a product. They might want to buy it as a component. They want to buy it as a consultancy service. Maybe you can just sell the training related to what you're doing. Maybe just providing support, maintenance, tech support, call centers, even doing subcontracting behind a larger system integrator, doing installation on behalf of someone else, lease out some of the equipment that you have, maybe even sell part of it away. But that's really getting cash. And that might tide you through that 1-2 months before, perhaps things turn better. One thing that I've learned is never underestimate marketing budgets. Marketing budgets are a very hidden source of cash that a lot of startups fail to see. These are marketing budgets not for yourself. These are marketing budgets of your potential customers, of your potential distributors and partners. In what I've done in the past when I was doing back-end systems for banks, I was able to get free servers, free state-of-the-art servers from then Sun Microsystems because they were launching a new range of servers. I could get a free server from my partner. I brought it to the bank. I offered it to the bank. The bank did not pay for the server. I didn't charge for the server, but paid for the services related to the server. And I provided an entire solution without even spending a cent on the server. And that server came from the marketing budget of my partner because they were trying to launch a new line of products out. I mean, similarly, where you see here with Amazon credits, Google Cloud credits, all these are based on marketing budgets. Use as much of what you can get and make money from there. The second thing would be perhaps loans from your existing investors. You may have fundraised in the past. You have investors who have already put in some of their capital into you. You could easily, okay, I think that I don't think you can get it easily, but you could ask for a loan from them. Perhaps with a shorter repayment period, a smaller interest, but get a short-term loan just to tide through a period where you may need more cash than what you have right now. Bear in mind that the whole investment side of things and the mechanics behind it doesn't mean that you get more cash, because I mean, one of the experience I have after fundraise is that investors expect you to spend even faster because they expect that $1 that they put into you to become $20 eventually. And if you keep that money in your bank account, they're going to say, you're not going to make my money work for me. So when you want to fundraise or when you want to get money from investors, bear in mind that they will be pushing you to spend. And that comes with a lot of, I would say, caveats and stuff that you need to worry about. Other sources of money could be grants. I mean, governments give good grants. Large social enterprises out there give good grants. There are competitions out there. They give you good marketing. They give you a bit of sometimes a bit of money that you can earn as if you're in the top prize or something. But they also give more than just a pure cash, because there are visibility, there is marketing, there's a lot of other things that come with it as well. And not to say that there are also things like interest income, right? I mean, for example, you have some cash in the bank. Are you investing it properly, or are you just leaving it to earn the 0.01% interest? Are you even putting it in a fixed deposit, for short-term fixed deposit, to get a little bit more cash? Tax even plays a part. If you are a GST registered company, you are charging GST to a customer, and you only pay GST, say, at the end of the quarter. There's that extra buffer that you may have to use for whatever purpose you want. But obviously, at the end of the quarter, you still have to pay the government back for the tax, but there is a bit of cash that you can use. So I'm trying to say that you have to be flexible, really, about trying to get cash, and a little bit here and there actually counts. And let's not really underestimate what little bit really can amount to. So that's just getting cash. Another thing that I learned, and this is again resonated by Ben, is that cash flow is really a full-time job. When I was running the CEO of a company, I thankfully didn't need to touch cash, because that was my CFO, COO's role. There are two separate roles. I was responsible for revenue and P&L, where I handled business model, go to market, product management, all that stuff. But cash flow is a totally different animal altogether. It is a full-time job, and it's really a finance function. You have to manage liquidity. Ben said you need to keep 6 months. Why 6 months? Perhaps your sales cycle is a 3-month sales cycle plus payment terms of 90 days. That makes up 6 months. And that's really how you have to have enough liquidity to match your operations. Do you decide to hire or outsource, lease or buy? Even collections itself, right? Earn more, earn less. Earn earlier or earn more, kind of thing. Do you want to reward your customers if they give you money early, or do you want to punish those who are, delinquent in their payments? Reducing your principal versus interest payments. Even and if you start to expand overseas, forex hedging, short-term investments in different currencies play a very big part in how you manage your cash, especially when you start to hire your team in different countries, different jurisdictions. Tax becomes a crazy thing. There are a lot of different jurisdictions on how tax happens. There's even trying to move money between countries attract tax. There is, withholding tax. There's so many other things that need to be worried about. And therefore, you need to understand how these work across the different jurisdictions that you are operating into, and make sure that you have sufficient, not just in your headquarters, because if everything goes to your headquarters and then you disseminate out again, you realize that it's a really bad way of managing cash. And I guess my third point would be, how do you reduce burn? And I'm very sure there's a lot more, but to me, HR is key. And it's something that's not very obvious, but you realize that as we are all, I guess, I came from a tech startup background, and we're doing a lot of tech stuff. Many of the teams that I work with in EF are also tech. Salaries and compensation, or essentially people, make up 70 to 80% of a startup's burn. And this is a crazy number. Let's not underestimate what it is, right? It's 70 to 80%. Even if you adjust or manage or reduce a few percent of this, it's more than some of the capital expenditure or some other big ticket items that you have in your balance sheet itself. So figure out what's your company culture early. Figure out what's your hiring strategy early. Are you only hiring the best? Are you, maybe there's a whole range from the best to the good, to the maybes, to the contracting, to the interns, to the outsourcing, freelancing. All of them have their plus and minuses. All of them have their costly and they're cheap, and trying to understand and establishing a company culture gives you a view of what your HR spend is going to be, and actually establishes a company culture that allows you to, I wouldn't say save cash, but it allows you to project better because you know what you're going into. You don't look at someone who applies and says, yeah, should we or should we not. You immediately know whether does this person first fit in the culture, and then you decide whether to hire or not. And that moves things a lot faster. um, I cannot teach you how to hire, that's really your own, but I will give you some observations. And the number one thing is, money is actually not the number one consideration for tech talent. You realize that even if you hire the best and you paid the most amount of money for this person, you might not be able to retain this person. You know, getting your business into something exciting, having a dynamic CTO or team lead where most of your tech talent can look up to learn from, becomes a very attractive proposition for them. I mean, I think if you read some of the old stories of how Steve Jobs was hiring to build the Mac and stuff, he never paid the well. He never paid well at all. But you get the best people working the hardest like crazy, just wanting to get it done. And that is the kind of company culture I'm asking you to do. Can you build to that level? Because that is going to save you a lot of money and move your company forward even faster. Second thing that at least for me was this trust and transparency. Thankfully, I was able to engage with my team when I was running a company, and I shared openly about the deals we had, uh, issues that sometimes we know we may have a cash problem or we didn't go through. I didn't go through, my company didn't go through COVID, but we went through SARS, we went through the Asian financial crisis. So we had our challenges. And there were times when we had to cut bonuses. There were times where you had to freeze salaries. I didn't have to fire anyone, thankfully, because of that. But it was a culture that we were able to engage with the team. One of the craziest compensation things that tricks that I've done is that we had sales commission paid to everyone in the company. Usually you hear about sales commission only paid to the sales guys or perhaps the sales engineers who may have a bit. We had this commission that was paid to everyone in the company, down to the admin stuff. It was a small percentage, but our point was that everyone was contributory to closing the deal, to delivering the solution, and to collecting the money. So everyone was sort of helping each other, and every time a project was closed, signed off, and invoiced, everyone was celebrating because maybe for that day I just earned $2, enough to buy a very small packet of chicken rice. But everyone was happy because everyone contributed to getting something done, and it just came out to a small amount at the end of the week or month, but everyone was just very, very into this because they sort of know what to do. It wasn't competitive, it was helping each other to really try to get more. And that was something that was I was very shocked by how it is. I need to highlight that it was a nightmare for my finance because trying to calculate the CPF component behind it was a nightmare. Imagine when your CPF contribution every month changes, CPF starts to ask questions and a lot of other things that happens. But that was a very fun thing that we did. And maybe you can try something that's similar but I would say that the whole trust and transparency behind how your company is growing with all the employees played a very big part in how we could actually manage our cash there. And the third thing we learned, expansion into new markets is always more costly than you think. It's no matter how you project it, it's always more costly. There will be a million and one things that you'll never think about. There are many companies that will say, oh, hey, I got this inquiry from this country. I've never even done anything, and they're inquiring to try to buy something from me. Think carefully before you do. Work it out. I'm not saying no, but you have to really work out your subs. Because if you have a customer in a country that you don't have resources in, imagine the support needed, imagine the overheads you need to actually carry out to help this customer. Do you have enough to actually expand beyond that? Because myself being in the B2B side of things, you need to have a certain market share within a country or locality before it really turns profitable. The first few deals, you're gonna lose money, not on the gross side of things, but on the net side of things. And you really need to plan before you get there. And if you are really planning on expanding into a new market, perhaps it's time to fundraise, because that's a growth strategy that you're going for. That's a plan that you're going to grow bigger than what you are, and perhaps the fundraise comes into play, and the whole cash control consideration doesn't. But please be careful when you just expand. I've met so many startups who just say, I'm just going to try to get a reseller here and a customer there, and they realize that they're going to lose more money than they actually make in the first place. So these are the 3 points. I hope this short session gives you a bit of flavor of what you can do, at least some action points of what you can do to get your cash flow moving.
Thank you, Tia. That was fantastic. Elise, do you have anything to say, or shall I move into the third speaker?
I have something to share as usual.
Okay.
Yeah, so TechCoin is also hosting another session at Makan for Hope Festival. This is slightly later, so do join us. I think TechCoin, you can see from our presentation that he really has been through, a lot and have a lot to share. So he will be talking about cybersecurity at the session. I think it's very interesting, in terms of emerging trends, but you can also use the opportunity to ask more questions about, his company building experience and other questions you might have. Yeah. So thank you. So I'll hand the time to Mark.
Thank you very much. Yes, that was fascinating. And we're moving into our third speaker now. I would like to welcome Boon Chu, who is the founder of Tapolo, to share his thoughts.
Elise, you have to stop your stop share, right? Your screen share.
Okay.
Can you guys see my slide?
Yes.
Yeah.
Okay, cool. Okay, so I'm going to be approaching this topic from a different angle, or slightly different angle. So a little bit about myself, so you kind of tune your question to me in a different way. I have a mobile apps company based out of the US. And what we do is we help a lot of market leaders and startup founders build their apps, so execute their mobile initiative. But in the process of me running the company over the last 10 years, I've actually had to experience a lot of the startup things that you guys experience as well. So and along the way, we have to also help a lot of solo founders build out their startup, and then some of them actually became quite big by this time. And and we have had to also innovate a lot of different things as well. So today I'm going to be sharing some of the experiences of me building, sort of my startup journey, sort of my mobile apps journey, and also the mobile apps company journey, but also some of the things that I see from the solo founders that we work with, not just solo founders, but just founders in general that we work with as well. So number one, root of all evil, cash. If you look at the top 20 reasons, I'm just showing you the top 5 right now. It shows that the first one is no market need, second one is run on cash. And so you think that, okay, cash is like the second, sort of cause of, like the why startup fails. But if you look deeper into this list, you actually realize that cash is the reason why all five reasons are there. If you have a poor product market fit and you need to pivot, one of the problem that why it even says that the startup failed because of no poor product market fit is because they run out of money before they can pivot to other ideas, right? So same thing with not having the right team as well. If you don't have the right team, it doesn't really cause you to fail. It's more like when you try to move towards having the right team, you run out of money, you fail again. So at the end of the day, if you look at this list, it all comes down to really not having enough cash. Because if you do have enough cash, any mistakes that you make in the process of running your business can be corrected. They all become learning. But if you run out of cash, then learning becomes fatal. The mistake becomes fatal. So really, at the end of the day, the lack of money is root of evil, not the money itself that is causing. So it's not really the money that's causing the issue. It's more like the lack of money that's causing all the issues that you run into. And one of the things that, so I'm talking about some things matter. Like sometimes, a lot of times when you hear, when you come to sessions like this, you want to, hey, kind of try to get some action items. But sometimes it's not so easy. You might have a question, you don't really know what to do to solve a certain issue. So one of the things that you can do is to apply the principle of inversion. So what that does is, if you can't really figure out what to do, at least figure out what not to do, right? So if you say that, if I'm going to be going out and hire 50 people today, I'm going to have 3 months of runway, I'm going to die in 3 months. So don't do that. So figure out the things that will cause you to fail. Just avoid those. At least you're going to be in a good spot. It may not make you succeed right away, but at least you're not going to fail, right? Because part of the things about startups failing is that they all sort of fail. If you look at the reasons why they fail, you can kind of lump it together. In terms of why they succeed, it's a little bit harder to replicate, but you can replicate a failure pretty easily with startups. And the second thing is run out of cash. So what I mean here, to know what it means to truly live die first, is that you might want to actually simulate an event of you running out of cash. Because until you really go through that psychological event of you really not having enough money, obviously now you're kind of faking it, but you really want to kind of just like put some money away. Because a lot of times people would get $1 million in the bank and $2 million in the bank, they feel really good about it. But that's actually really bad, because when you have $1 million in the bank, you really want to sort of tell yourself, maybe I only have $300,000 in the bank. Because the behavior of you thinking you have $1 million in the bank is going to be different than when you think you have less than that. So I would say, when times are good, at least, cover some time and simulate an event if you can, to say, I'm going to run my team as if I want to have $50 in the bank. No, not $50, but something low in the bank, right? And then see what it really feels like. Maybe even tell your co-founders that you will have a little money in the bank and see how they react. Because when you go through that event of really having very little money, it creates, first of all, you're going to get into anxiety and worry and all that stuff. So you start to have to introspect a lot. I think a lot of introspection happens when you run into issues, not when you're having a good time. So this, I think, is going to be a pretty useful exercise that you can explore. Another thing is to try to also repair your roof, or even build your roof when the sun is shining. And you might be surprised to know that, I'm not sure about Singapore, but at least in the US, when you go to the bank, when you need money and you go to the bank, you actually can't get the loan because you'll be in such a bad shape they don't actually give money to you. You actually want to go to them when you don't need money, when your financials, statements and everything are really healthy. That's when they look at it as like, wow, you're growing this much. I'm going to give you a couple $100,000. So you don't even need to go to VCs at that point. When you have a good financial statement, you can go to them and they will give you a big chunk of a loan to grow a company as well. So, and you don't give up equity in that sense. You just get money from a bank and you pay them back. But funny thing is, if you wait until you actually need it, you're not going to get it. There is a concept of good debt and bad debt. So, I mean, I'm not sure about if it is for all culture, at least from my background, that we're taught that, savings is good and debt is bad. But when it comes to running a business, there's actually a good debt and bad debt. But if you can get a debt that will allow you to grow faster and generate more revenue, that's a good debt. But if the debt actually does not generate anything for you, then you can see that as a bad debt. So you do want to differentiate, because I think a lot of times people either shy away from getting VC's money or getting bank loan or even line of credit because they think that debt is bad. And that's not really the case. A lot of times you need to get bigger by using someone else's money. And so there's one concept called blitz scaling. So blitz scaling is a concept of really scaling really fast in many different countries. And that requires a ton of money. And if you don't, a lot of people don't really go that route because you have to obviously get into a lot of debt, but then you have to scale really much slower. So at least have that in your arsenal, in your toolbox, so you can explore that when the time is right for it. This is another thing that I think I run into a lot with is the self-awareness. I think when you're running a business, you are sort of a part of the whole company that you're running it's kind of like an organism, right? Like if the founder or the teammates all have like bad habits and they don't sleep well and they don't exercise and all of that, it's all going to reflect in the operations and the product and everything. So you have to focus on the top line for that to reflect in the bottom line. A lot of times you cannot just focus on the bottom line and hope everything is going to come out okay. You have to be a fit person. You have to think, you have to eat well and all of that stuff. All that top thing requires self-awareness. Like if you're not doing the right thing, if you're watching too much TV as a founder, all that stuff is going to cause issues to the company that you're running. So awareness to me is really important. And a lot of times people will say that I don't have the discipline to do this and that. But at the end of the day, if you have the discipline, if you have the awareness, that's going to give you enough motivation to create the discipline. And then when you have the discipline, that's going to create a lot of freedom for you and your company. Financial awareness is another thing. I think a lot of founders, especially someone like me, we come from a design and tech background. We like to build stuff. We don't have to deal with the numbers. We would just happily outsource that part to, an accountant or finance person. But if you look at, even if you look at, so the background itself, I got that from sort of the Yahoo Finance, right? If you look at Yahoo Finance, income statement, balance sheet, and cash flow, those are those basic stuff you need to know as a founder. So I would advise that when company is still small, don't just go straight into getting someone else to do the numbers. Do it yourself. Even if you're hiring someone that would take care of the day-to-day, accounting, the bookkeeping, you should still always have that numbers in your mind in terms of runway and all that stuff. Is super important. You have to find enough reasons and motivations to love it for you to. I've seen a lot of. So I've run my business for more than 10 years now. A lot of companies that were starting around the same time when we started, building stuff, building apps for iOS 2.0, they've gone out of business. I think part of it is that the founders are so focused on building things and not really on the cash side of things. So be careful with the build first mentality. Sometimes you want to get into things you're not really good at and not really happy, to deal with. Team awareness is super important as well, like what I think they're going to mention. I think what his innovation on sharing commission with everyone is super cool. But what that does is it increases team awareness. Everybody knows, like, hey, I'm making money, I'm doing this. Awareness is such an important thing because it affects your behavior. And so your entire company should be, and a lot of companies don't really have a good level of transparency on cash flow and stuff. If you go ask the folks that are working at the production level, how much money does your company have, or what is the runway? Most of them don't know. But if they know, that the behavior is going to be different. And I remember when I was working for Amazon years ago, right, like maybe first or second week, they instilled the whole concept of frugality into me. Like if you look at frugality in this thing right here, it's actually in the Amazon Leadership Principles website that is on their site, and you can see how it says constraints breed resourcefulness, and that's the truth. When you have $1 million to work on to execute a project, the way you go about executing a project is going to be different than when you have $100,000 or $50,000 to execute a project. You have to be creative in how you structure the team, how you what kind of features you want to pack. All that stuff has implications. So sometimes having too much money is a curse. It's better that you exercise the discipline to have minimum amount of money to execute things, so that you can let creativity sort of flow to help things be more efficient. Feedback loop is super important. As a tech person, especially if you're running a company that has most companies these days probably need to use tech in some ways. You want to use technology to install and increase a feedback loop in your operations, because at the end of the day, you need these things to again increase your awareness, to let you know that something is not going well. When I came to Singapore 6 months ago, I started realizing a lot of businesses, especially the traditional ones, are using just WhatsApp to run their company, which is amazing to me, right? And you have a 1,000-person company and they're just running, all the departments are running things off of just WhatsApp, which is like, for me, it's very dangerous because they are, they have good cash flow, so that hides the issue. But this is kind of like a leaky bucket in a way. So as a founder, you have to make sure that even when you have good cash flow, you have to always still watch out for a leaky bucket. Like, is your bucket still leaking when maybe the rain is pouring so hard that you don't really see the bucket leaking, but you have to know it, because when the rain stops pouring is when you start getting into trouble. So things like Jira is a way to manage issues in your day-to-day operations. GitHub is another thing. If you have to have someone build your, especially if you have someone or even within your team, GitHub would give you a lot of feedback in terms of what, what code someone has written and things like that. I've seen so many cases where someone would go outside and get someone to build something for them, but they have no idea to ask about even as simple as GitHub access. With something like that, if you know it from day one, you can see the kind of changes they're making, how much changes they're making. You can monitor the output, the speed, and all of that, and that will allow you to control your cash. Because if you hire someone that is just working very slow, you're gonna cut it loose, and that affects that. So feedback loop is super important when it comes to executing your project and running your startup. Sorry, 1 second. I think compound effect. I think Taekwon and Ben mentioned this about this. Sometimes you also want to think about, it's all about big pictures, right? I'm touching on different pieces. Another thing you want to think about is the cost. If you have cash sitting in your bank, do you want to use some of that, reinvest that? A lot of times I see startup founders, they either, especially when they have a small team, they would take do like a director's draw or whatever. They would just take their money and go spend it on themselves. And that's not a smart way. When you do that, you actually slow down the growth of your company. What you want to do is reinvest as much as you can back to the company and make it grow even faster and faster, and make the engine make the wheel become bigger and bigger. So that's something you need to, I'm not saying that you just go and do it. You have to at least think about this part to see, because if you spend so much money on yourself and not really on feeding the engine that you have, then your growth is going to be slower. Tech hiring, my strategy when it comes to tech hiring, again, Taekwon mentioned this as well. It's when it comes to running, whether it be even a big company or a startup, the human component of it is such a big thing, because at the end of the day, it's just people doing stuff, unless your company is just run by a bunch of robots, right? So tech is especially important because they're so expensive. And my strategy is hire fast, fire fast, but promote even faster. So what I mean by that is you can't really tell from just having a 30-minute interview with someone to know if they are, you can kind of filter it out, at least the bad ones, but they are still not guaranteed to be good. So you have to hire them, get them to do stuff, but have your A players in your company to monitor the work. And if they're no good, give them 1 or 2 chances and just let them go. So what I like to do is not just get someone full-time right away, because with full-time, you have labor laws and stuff like that could make it more difficult for you to get rid of someone quicker. Sometimes I'll just get them on a part-time basis, just to try them out, see how they react, behave under stress and all that stuff, ability to take feedback. All those are really important components. So promote faster is also important. If you know someone that's really good, don't just sit there and wait for the next year to come before you give them a pay raise. Just like do something quick so that they know you appreciate their value. Do you need an CTO? Do you use an agency? All these are things that you should think about. I would tell a lot of founders that you don't actually need a CTO that soon. A lot of co-founders would try to get a tech CTO because they don't want to pay money. So they would use the equity and try to save money that way. But I don't always think that's the right strategy. It really depends on that person and also the overall project as well. But we can touch on that if you guys have questions on that. Optimization over fairness. This is one thing that I think the world is sort of like having the mindset of, hey, this is not fair. We have to first ask ourselves a question: is fairness even the most important thing? When it comes to running a business, capitalism. If you think about it, capitalism at its core is about optimization. It's not about fairness. Fairness is more like socialism and communism. So when it comes to structuring the way you run your business and the way you treat do your HR policies, you should go for optimization and not for fairness. Meaning that you shouldn't have one rule that applies for everyone. You should look at, okay, this person might have a different whatever, and maybe they want to have a different way to work. You should have that framework and flexibility allow you to optimize output from your team. Second order consequences is a good concept to think about. A lot of times when we deal with cash flow and making cash flow decisions or decisions that have cash flow implications, we only think about the consequence that comes right after the action. We don't think about the second order consequences or third order consequences, right? So the ideal consequences is that whatever action you do is going to have a first order consequence, which is the immediate consequence. But then the consequence can also breed other consequences as well. So you got to be careful about that part and really incorporate second order thinking into your decision-making process. So I'll give one example with the price tag, for example. should you get a $200 monitor or $500 monitor? Most companies, including big companies, will be like, of course, $200 company, monitor, because I can save so much money. But the thing is, did you measure the amount of productivity gains if your employee is going to get the $500 monitor? Can they get, are they going to get eye strain when they are on a $200 monitor? You know, that the ROI is super important to measure that. But a lot of times people just look at pricing and say, oh, $200, let's just go with it. But that you actually end up costing more money than less. So that's why when you look at price tag, don't just say $200 is cheaper than $500. No, it's not as simple as that. Hidden tech cost is another thing that is very tricky, but also you should be aware of, is whatever technology you're using to build your thing, there's always that switching cost. Meaning that if you use something like, sometimes these days, some people might be using, say, no-code solution to build something, but you got to think about, okay, I'm saving a lot of money using no-code, but what happens if I need to switch it to something else later? What is the switching cost for that? What is the cost of not having IP? A lot of companies would hire someone, a vendor, to do something that they couldn't do. And then, but obviously they don't have the IP because it's all provided by the vendor. What is the cost of that? Because when you sell a company, is it important to have that IP? Is it important to have the data? All that stuff you got to think about it. It's not just the price tag itself. Opportunity cost is also a tricky thing, very difficult to measure, but you got to take it into account. Because at the end of the day, if you're like, what is the opportunity cost of me not adding one more person to the team right now? Are you, so that's the part that you need to think about, because that has cash flow implication that can accelerate or decelerate the amount of money that goes into it, comes to you. Lastly, the thing that I always say to tell people is question everything. Do you need to have a CTO? Do you even have to have a tech co-founder? For example, like pay raise. Do you do time-based pay raise or skill-based pay raise? Like, do you want people to come to you for a pay raise just when they hit the calendar year? Or is it more like, and whenever they get good new skills that are important to your operation, that you would just increase their pay, right? Compensation model is important as well. In my team, we have this thing, have this fund where we would give a person 2 weeks of their salary every month to spend on their family. They can't spend on themselves, they can spend on their family. So the idea is that because your family, your spouse or your parents, they sacrifice for not, because the more you work at our company, the less time you can spend with them, right? So that's sort of a way to appreciate that sacrifice that they're making. Now, the nice thing about that effect is that obviously, if you quit one day, they're going to be like, why did you quit? They're going to help you monitor as well, and say, why did you quit such a good company? They treat me so well, right? But this is the kind of innovation you want to kind of build into your operations. And code auditing is another thing that's important as well. Whether it be hiring someone internally or hiring someone outside to do your thing, how do you know they're doing a good job? Why don't you hire someone, additional team, to help you monitor their work to make sure that they are doing the job? Having second opinion, third opinion is always good. Don't run into a situation where you get the final product and you're like, oh, the whole thing is bad, when you hire someone to take over the project. Things like exit interview, right? That's another thing that is very common, where HR is copying HR. Like, every company is copying the same model. But I asked the HR company themselves, I said, why do you even bother doing exit interview? Why not do pre-exit interviews? Like, every single person that you hire, interview them maybe every few weeks or whatever, and make sure they're happy and they have no issues and all that stuff. By the time you get to the exit interview, it's too late. There's not much you can do. So things like that, you also would want to question them. That's all. Yeah, that's all.
Boon, actually, we were hoping to hear quickly, about the consideration for making mobile app development, but maybe we can do that later. So I will hand the time over to Mark, who will moderate the question. And I think some of you, we are over time, so some of you may have to leave, but that's fine. You can join our linking group. You can leave a question here, and then we will share, the answers to the question after we discuss them. So over to you, Mark.
Thank you very much, Elise. Yes. So I'm going to dive right into it. All I would ask from our panelists is if you can obviously try to keep the answers just a little bit short, so we can kind of fit in a few of these before people have to go. So the first question I have, I'm going to direct this at Ben, but if someone else has something else they really want to kind of dive in with, please go ahead. So someone asked, what is your advice if a company fears to scale during challenging times?
Well, yeah, I read that question. Well, I don't know how to give you a short answer. I mean, if you are not certain of what if you're uncertain of scaling up, or you don't have the conviction to scale up, even during uncertain times, you shouldn't do it. Basically, that's it. The question is, even during the uncertain times, how can you find can you alter your strategy, or can you find find another way to make use, make what you have work even in these times? So I think the question is really about the question really about you asking yourself, given the current situation, how can you change your own strategy to get the conviction to scale up? But obviously the short answer is, if you're afraid of scaling up, in uncertain times, then you shouldn't do it. Yeah, that's my short answer. I don't know whether that's helpful.
Mark, if I can have a shot at it. So
Of course.
yeah, so scaling up is always a good thing, right? I mean, you're trying to expand, you're trying to increase your revenue, you're trying to get to new markets, and that is in fact to me, I see it as a situation in your company where it's investable. So if you are afraid to scale up, why not outsource this validation to someone else? Speak to investors, speak to potential people who will evaluate on your plans to scale up. And if it is really as good as what it is, first of all, they will want to put money in your company to fund that scale up. And if it is not as good as what you think it is, then you got your answer, right? So you always can get an opinion in this case, because scaling up, again, it's an investable decision, and there will be people who will tell you right or wrong.
Yeah, I totally agree with that answer. It's a great answer. You need to find a way to validate it. Investors are one source, but your customers also another source. So I suppose the other answer to the question is, you make a business plan and go talk to people and see how many people will support you as you scale.
Thank you. So Boone, I've got a question for you. One of the participants asked, they've secured 2 grants this year with a 2-man show. What is your advice on kind of dealing with that discipline and burnout you were talking about with founders?
What is the question? Burnout?
So yeah, burnout. So basically they asked, they're a 2-man show. They've already secured 2 grants in this year. So obviously they're working kind of, 24/7. And so what's your sort of kind of advice on how you handle with burnout when you're dealing with realities of a startup?
Yeah, I think the thing that I mentioned in the slide itself, one is awareness. You got to make sure you don't get to even to that stage, right? You got to make sure that you are in good state. A lot of founders, they are working day and night. They don't exercise. They don't do the right, they think that, working more is some people even glorify the sort of the need to work overtime every day. So first of all, you have to have that awareness. Second thing is, if you already have the grant, see how you can make use of that to amplify, because as a founder, you have so many things to take care of. So the beauty right now is that there's so many different countries that have so much good resources. You have to kind of think about the amount of value, that the amount of, like, if your time is so cheap, then obviously work as much as you want, right? But if your time is expensive, you really should get someone else to do the coding or whatever that you need, and then you do something else that is more expensive that no one else can do. So I think to avoid burnout, the number one thing would be delegate as much as you can to people that can do the job better than you, and then you do the things that they cannot do, but also focus on the big picture as well. Yeah, I mean, there's if whatever you do, just don't do whatever you're doing yesterday. Just don't repeat what you're doing, and that would probably help you a lot. Yeah.
Thank you very much. Tiak, I've got one specifically for you, because I think it came when one of your slides was being shown. Asking for loans from your investors, what's a feasible interest rate?
Well, it depends on the investor that you have, right? I mean, is it Innovent who already has a certain kind of return that they expect, or it's a Series A or it's a seed VC? All of them have their funds, and their funds project a certain amount of IRR, internal rate of return. I mean, you're looking at somewhere between 8 to 20%. It's somewhere around there annual, and they need that kind of return, or they expected a kind of return. If you're going to borrow for 3 months, then amortize it. I mean, just basically calculate the specific kind of return that they're looking for, and that's probably something that will fit. It is way higher than your bank collateralized bank loan, but certainly lower than a open credit line that we're talking about. So gut feel, it's going to be ranging between 12 to 16% IRR.
Okay.
Ben,
anyone else?
What's your return?
Oh yeah, no, with 10% plus warrants. But no, I think if I may just add, you know, the difficulty if you're asking for loans from your investor, let's say if your investors are angels and not funds, I've from experience, the investor just going to ask you back the question, so what do you think is fair? So it's going to be different from everybody, but how do you attack this question? Like, I think you do it like this. You first look and see whether you have been able to, the company has been able to obtain any debt financing before, what interest rate you got there. Okay, and if you haven't, you can't obtain any debt financing interest rate before, then do a Google search in Singapore or whatever jurisdiction you are, how much the smallest business loan of advertised by the bank is. Add about 2 to 3% to that, and that's your number. And then when the investor tell you how you got that number, you say, hey, actually, I'm a small business. This is the small business lending rate, but I mean, I'm a startup, I burn cash, so the bank may not give it me, so I put a premium to it, and that's it. That's how to, and in truth, I think I see a lot of people benchmark the loan price that way. But of course, please look at bank, look at other investors, look at P2P platform also. Then you kind of know.
Okay, well, I think we've actually run out of time because we are 10 minutes over. There are a few more questions in the chat group, but I think we can kind of take that offline a little bit. I know you all got things to do and kind of move on. But first and foremost, I want to thank every one of our guests today for joining us. It's been incredibly insightful. You should see all the comments if you haven't already seen them in the chat group. They've been kind of very, very positive about your insights. Again, I'll pass over to Elise if she's got any closing comments or anything else to say before we kind of leave.
Sure. Yeah, thanks everyone. Thanks our panelists, our participants for staying, past the time, and also Mark, for moderating. So I just shared that, join us for more Makan for Hope events, especially now for our Makan for Hope festival, so that because we are still fundraising, we have raised 90,000, but we are still away from the 125,000 goal. So join us for a session. We also have 2 groups for you to join. Anyone can join our linking group. So this is called Makan for Hope. There are now over, I think, 400 people inside. So, you can get more, you can ask questions, you can network. And then if you are entrepreneur, founder, people working in startups, I also share a Slack link. So you can also join, our Slack community of over 500 founders across Asia. So this is like a safe environment for you to ask questions, for you to share knowledge with each other. Yeah. So Andrew, do you want to add anything before we end?
I'm good here. Thank you everyone for joining. Look forward to meeting you all at the remaining sessions.